Ladies and gentlemen, welcome to Out of the Black Box, a financial brain scan for the LLM webinar. It's our great pleasure to invite Professor Hui Chen to give this online speech. This webinar is organized by the MIT Industrial Liaison Office and the PEP Foundation. Firstly, let's welcome Mr. Phyllis He, the chairman of the PEP Foundation, to make the welcome remarks and introduce Professor Hui Chen. Chairman He, please.
Thank you, Ivory. Good morning and welcome. On behalf of the EPOC Foundation, it's my pleasure to open today's webinar, co-hosted with MIT's Industrial Liaison Program. For over 3 decades, EPOC has worked closely with MIT to connect leading Taiwanese companies with frontier research and ideas. Today's session continues that tradition, focusing on a topic that is increasingly central to how we make decisions across industries. We are particularly pleased to have with us Professor Hui Chen of the MIT Sloan School of Management. Professor Chen's work sits at a thoughtful intersection of finance and machine learning. Rather than treating AI models simply as tools, he approaches them as systems that can be analyzed, interpreted, and understood using the discipline and structure of financial theories, among others. His talk today addresses a question that many of us are now confronting. As these models become more capable and more embedded in real-world workflows and decisions, how do we move beyond outputs and to understand and assess their reliability, their assumptions, and their limitations? I think this perspective is particularly relevant to the audience today as AI increasingly influences areas ranging from financial decision-making to operations and planning. With that, please join me in welcoming Professor Hui Chen.
Thank you, Mr. Ho. Let me try to share the screen. I hope you can hear me okay. Can you see my screen?
Yes.
Okay, great. Yeah, well, thank you everyone for joining us. And I want to thank especially the EPOC Foundation for inviting me to give this presentation. As a scholar, we always cherish the opportunity to share our research with really anyone who cares to listen. But this is really a special opportunity. So yeah, what I'm going to be talking about today is basically some of my current research on uncertainty quantification and interpretability of large language models and AI agents. I mildly changed my original proposed topic by adding that I really want to kind of present this line of research as starting from these black boxes that hopefully we're using daily to eventually a interpretable, accountable, collaborative system, meaning that we can actually put AI agents and human experts to work together very efficiently. So that's going to be my goal at the end of the talk today, kind of sketching out some of my kind of work in progress as well. Okay. All right, so let me start by telling you a little bit about the motivation, why you should care about interpretability, care about uncertainty quantification, and accountability. So I'm sure here's an example that everyone in this talk should be familiar with. You probably interact with various versions of the large language models or agents on a daily basis. Here is a very simple use case, right? Suppose you're interested in getting the answer whether TSMC, the stock price will go up or down in the coming week. You could propose this question as a prompt to your favorite LLM. The LLM probably, depending on the capabilities, might analyze various kind of information, and then after some deliberation, you see that it will provide an answer. So here's one example of the possible answers. And of course, what we care about here is the keyword at the end, which is that it's predicting the stock price can go up, right? If you prompt different LLMs, you might get a different answer. And if you prompt the same LLM multiple times, you might notice you get different answers as well. But one question that we should be thinking about is that if you're actually going to be making investment decisions based on the recommendation, it seems like it would be important for us to understand, is this prediction reliable? And secondly, what was really the kind of reasoning process behind it, right? That's kind of a minimum requirement here. Here's another example for those of you who are performing macroeconomic analysis. You might be interested in finding out what would be the inflation rate for Q2 2026. This is what would sometimes refer to as a nowcasting exercise. Again, as a human analyst, you might collect various kind of information, including the latest kind of business news, as well as what the Federal Reserve is thinking about, and potentially use all this kind of information to get at the market consensus for where the inflation rate would be. But you can also pose the same question to the LLM and maybe feed some news articles to the LLM for consideration. And again, with some deliberation, you could get some answer like this, right? So in this case, LLM is saying that the inflation rate will be somewhere between 2.8% and 3.2% on a year-over-year basis. Again, the question here is, are these numbers reliable? How much uncertainty or what is kind of the confidence interval we should be applying to these numbers? Let me keep going here. It's kind of pushing this question a little bit more. Should we actually trust the black box? Here's a non kind of finance related question, but it's more fun in a way. Imagine you prompt the LLM to give you a random number between 0 and 9. Okay, and here's the second prompt. It looks very similar. Give you a prompt and give me a random number that's between 9 and 0. Now, even though this question is not as precisely as we would like to be, if you are someone who has asked this question, the normal interpretation is that, oh, maybe we are asked to basically generate a number between 0 and 9, but probably with equal probability, right? Without additional information, this seems like a reasonable assumption. So the question then is, if I do this to the LLM, would the LLM have these kind of quote unquote reasonable expected behavior or not? Well, you can actually try this yourself. I encourage you to give it a try. But here is what happens if you prompt the same questions multiple times, right? For either ChatGPT or Gemini. This histogram here you're looking at is the result if we prompt ChatGPT, in this case GPT-4o, 10,000 times, right? So here's the histogram here. You can see that for some weird reason, the number 7 gets a very high share of answers. Even though there is some randomness in the answers, there's some mysterious missing pieces. For example, 0, 1, and 9 seems to be almost never get mentioned. For some reason, number 5 is very rarely mentioned. If you flip the order of prompting from 0 to 9 to 9 and 0, you get, again, a very different distribution, right? Even though it seems like on surface, these two questions should give you relatively similar answers, if not exactly identical answers. What this tells me is that the kind of behavior LLM, right, would have could be actually quite surprising and not easy to interpret or anticipate, which again pose a question when you have to rely on for performing high-stake decision making. Let me end with one last example here. Just again, kind of push you to think about whether you really can trust this black box technology. Here is an exercise from another paper that essentially uses LLM to perform some kind of a neurocognitive bias study. So in this case, what the researcher did is first showing the LLM a picture. Here is on the left, you can see there's a picture of someone who has a smiley face and is throwing cash in front of him. And in this case, the first question posed to the LLM is that, what does this image remind you of? And the LLM answers, it reminds the LLM of investors made a lot of profit in investing in the Apple stock. Okay, and then right after that, you ask the LLM to answer the following question: do you want to invest in a stock or a bond? Reply, only stock or bond, right? And in this case, seems like maybe random or maybe related, the LLM just answers stock. In fact, answers stock with a pretty high probability whenever it's prompted initially with a kind of a happy looking picture. Okay. Now, if you change the picture that you're asking first to here is a picture, perhaps in this case to basketball stars. It seems like in a crying motion. So the image, what does the image remind LLM of? LLM answers. It reminded LLM to think of Kobe Bryant losing the championship to the Celtics. And then LLM was asked to answer essentially the same question on the left. And then more than not, you find that LLM in these cases, after being prompted with a sad picture, their choice becomes more like the bond. Okay. Now, if you think about this kind of experiment a little bit more, you start worrying a little bit because in the first case, there might be a kind of a marginal case you can make that this picture is some kind of tangentially related to investment because there's money being thrown around. But there are a lot of examples that are used in these study that really has nothing to do with investment, right? It's in this case is a picture of basketball stars that have nothing to do with finance. They even post messages such as online kind of a social media platform messages as well as user reviews on Amazon or Yelp. Which has, again, nothing to do with economics or the stock market. Yet you see that every time when LLMs asked of a kind of a message or prompted with a message has positive sentiment, they're more likely to choose stocks. And when they're ever prompted with a negative sentiment message or image, they're more likely to choose bond. Is that the kind of behavior we would like to see in our LLM, especially when we're relying on these kind of agents or AI to make high-value decisions? I would say no, right? So in these cases, the question again is, can we really trust these kind of fantastic tools to make important decisions or not? So with that in mind, I hope this becomes now kind of evident that people in business and in the regulatory kind of circles all worry about this black box nature of the technology, right? On the one hand, we're seeing the technology just accelerating really fast. People are more than eager to embrace it and building very powerful agentic systems on it, which means you're essentially setting an AI agent loose and performing very complicated tasks. On the other hand, you just saw the examples I show you that even for these kind of a single round interactions, there seems like there is a lot of potential unpredictability and biased behavior. That is something that really should make us think twice about trusting them to performing important tasks. So what can we do? Well, what I'm going to talk about today in the next 30 minutes or so is some of my research that tries to open up the black box. Right? So I'm going to talk about mainly two papers, which I'm happy to share, and for those of you who are interested in reading more detail, as well as what I would call the next step, which essentially is some work in progress we're trying to do. So the first paper is essentially showing that we could actually use the existing large language model that are available, including most of the ones that you can name. We can easily actually elicit what we call an internal confidence measure for whatever answer they give us. So in other words, we could actually pretty easily tell when the LLM gives us an answer, such as the TSMC stock is going to go up next week, or they think the Q2 inflation will be 2.8%, we can actually get a sense of how confident they are in those answers, right? If they are actually quite uncertain about the answers, that likely means that the information we're getting from the LLM is going to be quite noisy, which should make us think twice about kind of trusting it with the very important decisions. So in other words, what we're going to show you here is that it can actually be used effectively to filter noisy output from LLM and distinguish it from precise information. The second paper is a little bit more ambitious. There we really want to kind of truly open up the black box and ask the interpretability. In other words, we would like to show you something about how we can understand the reasoning process behind LLMs. When LLM give us an answer, such as TSMC stock will go up next week, we can actually not having to take the answer at a face value, but actually get a peek at what is the reasoning process behind it. All right, and then the final thing, if time allows, I would like to talk a little bit about my kind of early stage research, which is talking about how human AI collaboration could be made much more efficient when we actually understand, for example, the uncertainties and the reasoning behind LLMs. In other words, we can actually more accurately identify the ways that the AI systems and the human experts will be complementary, and then making them together in recognizing this kind of complementarity in skill sets would actually make the whole system work more efficiently. All right, so that's kind of the roadmap. Okay. Yeah, so let me actually move forward in the interest of time. And by the way, you should feel free to interrupt if there's any clarifying questions I can help answer. So let me start with the first paper, which is essentially talking about uncertainty quantification for LLMs. Okay. So here's basically the main question we're asking, which is when should we trust the answer coming from an LLM, right? And this is a kind of a non-technical summary of the idea we have. Every LLM answer comes with what we call a hidden probability distribution. I'll explain this in a second, what I mean by that. And from this hidden probability distribution, you can actually relatively easily construct a measure of the internal confidence. Right? You can tell when the answer generated by LLM would actually be quite confident and when it would be actually quite noisy. We're going to show you why it is important to look at this kind of uncertainty measure. In particular, we'll show you that by filtering out these kind of uncertain answers, you can get actually much more effective signal extraction using LLM. So I'll show you a concrete example of this using a kind of a long-short trading strategy based on LLM sentiment analysis. Okay. So here is a little primer on LLMs, just in case you're not as familiar with the technology behind it. To put it in a very simple way, kind of the leading large language models we're using today, whether it's ChatGPT, Gemini, or the Anthropic models, they're all what's called a autoregressive large language model. Okay, effectively, they're basically predicting one token after another. In that sense, it's autoregressive. It has two parts. One is what's called a neural language model, and the other one is a decoding strategy. So the neural language model, which sounds kind of complicated, but it's actually quite simple. Effectively, whatever prompt information you give to the LLM, the neural language model will be able to generate a conditional probability distribution for the next word to follow. Right? So when I say token, it can be interchangeable with word. So effectively, here's an example. Suppose you want to finish the sentence, finance is, what would be the natural word to follow after finance? Well, a capable neural language model would then be able to produce a conditional probability distribution for the next word following finance is. So you can see here the prompting information is going to be used here as the conditional information. And then we can see what are the probabilities for all the possible words that can follow. Right? So for example, here you can see the word awesome has a probability of 0.1. The word useful has a probability of 0.4. The word boring, which many of my undergraduate students probably think that way, will have probably a 0.3. And you see that in this case, of course, these numbers are made up. But if you add up these numbers, you see that they actually add up nicely to 1. Right? So in that sense, this is a conditional probability distribution. So then what does the decoding strategy do? Well, the decoding strategy simply follows this conditional distribution and try to decide what next token to actually pick. So you can imagine there are some natural candidates here in terms of how exactly we're going to pick the next word. Let's actually look at an example. It's probably easier. One candidate would be, let's just go for the word that has the highest probability, which in this case will be useful, right? So that means whenever we ask LLM to finish the sentence that starts with finance is, that LLM that goes for the highest probability next token would then choose useful, right? You can realize if we do it this way, then the answer the LLM generates will be deterministic. You can prompt the LLM 100 different times. Finance is, they will always pick the word useful because that is the distribution it's drawing from. Right? So that's one possibility. The second possibility is that we can actually let the LLM choose what's called stochastic decoding. Effectively, it can throw a dice and choose the word according to their actual probability. So in other words, rather than choosing useful 100% of the time because it has the highest probability, the LLM would choose useful 40% of the time because the probability is actually 0.4, right? And there would be some possibility that some cases where awesome could be chosen and or boring could be chosen. So this is what gives LLM this kind of randomness and sometimes referred to as creativity. Right? In fact, you can imagine if the randomness is higher, then the creativity becomes higher as well. All right. With that in mind, now finally, you can see that when you want to generate not just one word, but rather a sentence, you just need to repeat this process, right? You can imagine that I first choose one token, S1, from the conditional probability distribution. Then I want to, so let's say finance is useful, right? Useful is chosen. Then if I want to continue, I just need to put useful as part of the prompt as well. And then ask the neural language model to generate another conditional distribution. What's the next word that's naturally following finance is useful? Maybe the word is but, right? So then you would choose the word but and put but behind finance is useful but. And then the conditional distribution would change accordingly, and you would choose the next token and so on and so forth. Okay, so that's kind of the idea behind how the large language model works in the probabilistic sense. The key thing I want to talk about is that once you realize there is this conditional probability distribution available, then rather than having this either deterministic or stochastic decoding process deciding the fate, right? What is actually the token that will be chosen, which will formulate the answer for us, we could actually just directly look at this distribution and figure out what is actually the uncertainty for whatever answer that LLM can present for us. So you can imagine that if this internal probability distribution is very tight, meaning that most of the probability mass is concentrated on one answer, then that answer is going to come into us with very high confidence, reflect on the part of the LLM. Right? So LLM is going to be answering very confidently. The answer must be useful. But on the other hand, if imagine the situation such that the useful and boring are in fact splitting the probability, so it's like roughly 50-50, then you can imagine now that there is actually quite a bit of uncertainty behind the answer useful. Similarly, there's going to be a lot of uncertainty behind the answer boring. That would suggest something rather different in terms of a lack of confidence in the LLM's prediction. Right? So that gives you the sense why we think this is actually a promising way to quantify the uncertainty. It should be pointed out that there are alternative ways you can quantify the uncertainty as well, which is what we refer to as the so-called black box of alternatives. There's some intuitive ones. One of them is you could just take advantage of the so-called stochastic decoding and ask the LLM to answer the same question many times. Imagine 100 different times. Okay, so if you sample the LLM 100 different times, would TSMC stock go up or down next week? And sometimes get up, sometimes get down. You just tabulate, right? What is the frequency of the word up versus down? You get a sense of how much uncertainty or confidence the LLM answer has. So that could work. But of course, this will be pretty costly because you have to prompt the LLM again and again. Whereas if you rely on the conditional distribution, you only need to prompt it once, actually. Okay, so that's kind of a clear advantage relative to that kind of approach. The second approach is actually an interesting alternative, which is why don't we just ask LLM to assess whatever answer they're giving us, how much confidence they have in those answers, right? So this is what's referred to as a self-declared confidence or model-declared confidence. So I'm going to show you some interesting experiment we do that suggests that the information content of this declared confidence is actually rather different from the inner confidence measure we construct. To put long story short, we cannot trust this model to self-assess their confidence, right? They actually don't have the ability to tie the answer to this declared confidence with the proper probabilistic foundation. That's really the reason behind this kind of failure. So here is a kind of a simple mental model, if you want. Whenever we prompt the LLM with some kind of news, filings, memo, questions, and then ask the LLM to generate an answer, we want to basically get what is the kind of the distribution behind all possible answers, rather than trusting one single answer LLM will give us at a particular point in time. Once you have that distribution, then you can imagine separating the situation into one of the possible three categories, right? Either we realize LLM actually answers this question with high confidence, in which case you can then think about either auto route or put high weight on these kind of signals. If it turns out that the LLM has only medium confidence, maybe not quite high enough to be acted on right away, then you can think about potentially having human review, or maybe asking for more information to try to sharpen the message. If it turns out that LLM has low confidence, then you can just use this as a filtering device and to throw out these kind of signals, because acting on them is going to be like acting on noise. Right? So as a result of that, you can see that with its strong kind of uncertainty quantification, you can have this kind of different workflows in terms of how to process and utilize the information properly. All right, so how do we actually show in the paper that this methodology works? We actually performed a what's called a news sentiment classification exercise. We took 100,000 news articles from Reuters, firm-level news articles. These are basically intraday news release between 9:30 a.m. on Eastern Time after market opens to 4 p.m. when the market closes. And then we asked the LLM, in this case GPT-4o, that's the time when the paper was written, was the latest model available, to basically classify whether the news is positive or negative. Right? So this is a binary classification, but remember there's a distribution behind it. So we're gonna try to calculate for every classification to make whether this is a high confidence classification or is a low confidence classification. In this case, we're going to use the actual realized return on that same day as the ground truth. So we can check whether the accuracy is high or low. Okay, so that's test number one. This is necessary for us because we would like to know if the LLM's self-assessed kind of probability distribution gives us a high confidence measure, does it actually correspond to higher accuracy in forecast? Okay, the way I would like to explain why this step is necessary is that just imagine that you randomly find somebody on the street and ask that person, do you think the TSMC stock can go up or down next week? Well, sometimes you're going to find someone who is very conservative, and they will say, oh, I'm really not sure. Maybe it's going up, but it's really 50-50. Right? So in this case, this person, just has lack of confidence issues. So you can think of this as a kind of underconfident kind of a scenario. Alternatively, you might run into someone who is super self-confident, and they will say, oh, for sure, 100% the stock will go up, even though this kind of confidence is probably unjustified. So in other words, we have a overconfident situation. Now, the LLM really is just like one of these kind of subjective agent, right, that you can find on the street. Hopefully, they can perform a little bit better than a random person, but still, we have to be mindful that we could be handling or could be facing either an overconfident or underconfident agent. So that for that reason, having a test like in test number one to verify if high confidence indeed corresponds to higher accuracy is quite necessary, because that would tell us that this kind of self-confidence is actually warranted, it's justified. And then in the test number two, what we do is we want to see whether these kind of signal filtering using internal confidence, inner confidence, is actually economically valuable. Right? How do you show it's economically valuable? Well, we construct a trading strategy using overnight news, basically from 4 p.m. market close to the 9 a.m. before market open the next day of this overnight news release. And then I ask the LLM again to classify the news into positive versus negative categories. And then finally, we would trade on these signals. Right? So you can buy the stock next day at market open if the classification for the overnight news is positive, and you would sell the stock at the market open, shorting it, if the classification is negative. But of course, the wrinkle we're going to do here is that we are not going to trust all the classification equally. Rather, we'll trust only the high confidence classifications and filter out, throw away those low confidence classifications. I'll show you what the difference looks like. Let's start looking at like test number 1, right? So here is the picture that shows all you need to know. So you can see here, if you classify or if you group this 100,000 news articles based on the confidence level, where bin number 1, right, 1/5 of the news articles that have the lowest confidence are sitting over here, and bin number 5 are the news articles that are classified with highest confidence. We then look at what is the subsequent accuracy of the classification. Remember that the classification could either be positive or negative, but we can check with ground truth what the realized return is to see if they're actually correct classification. So you can see that for the lowest confidence bin, the accuracy is basically 50-50. It's not that different from a random guess, as you would expect. Right? These are basically very noisy classifications. On the other hand, though, what's really promising to us, so if you look at bin number 5, the accuracy is actually much higher for this high confidence group, and there's actually a nice monotonic increase behind it. So this is basically telling us that high confidence predictions from the LLM, at least for the purpose of this news classification exercise, are indeed corresponding to higher accuracy, which means that using this kind of inner confidence to filter noisy versus precise signals actually could work. Okay. How well does it work? Well, here is the result from the trading strategy I described to you, which basically means that you can do long-short portfolio based on whether news classification for the overnight news is positive or negative. This is the baseline on the far right here. This is the baseline result, which means that you just do the trading strategy for all the possible news there is without doing any filtering. You can see that actually the LLM, the 4.0 here, actually performs surprisingly well. This is a annualized excess return on the order of about 40%. If that looks too good to be true, it is because this is a very high turnover portfolio. For those of you who are familiar with this kind of trading strategy, this requires you to turn over your portfolio 100% every day. So it's going to involve a tremendous amount of transaction costs. A lot of these return probably will be eaten up by the trading costs over there. But nonetheless, the high return here shows you that the LLM is picking up some useful signals. Now, what's most interesting to us, though, is that looking at the first column on the left, you can see this is what happens if you only trade on those signals that come with high confidence. You can see that the expect excess returns is now another 10 percentage points higher, and the Sharpe ratio is also significantly higher compared to the baseline case. Compare that to the low confidence group, right? So this is about roughly a little bit more than 1/5 of the sample, which has the lowest confidence. If you trade on only these kind of classification signals, your mean return, excess return, actually is negative, and your Sharpe ratio is basically indistinguishable from 0. Right? So that just basically shows that if you're using these very noisy signals, you can actually hurt your portfolio performance. For fun here, actually, I'll show you here what would happen if you didn't use this kind of inner confidence measure, but rather use what's called a declared confidence. Remember, you can get this declared confidence simply by asking the LLM to self-assess, right? As another prompt, self-assess whether they're confident in their previous answer given to you or not. Well, it turns out that using that kind of a self-assessed high confidence, you get an average return that's basically no different from this value over here. The Sharpe ratio is lower. So what is happening? This basically tells you that trusting these kind of signal selection using high declared confidence is like just randomly selecting a subsample of these original sample of news here. Because it's a randomly selected subsample, it's no surprise that the average return will be the same. And because it's a smaller number of stocks, the diversification is deteriorated. That's why the Sharpe ratio becomes lower, and it's because the volatility is higher. Okay, so I think this contrast between this column here for this high inner confidence versus high declared confidence shows you that not only should we take into account confidence of LLM, but we need to do it in a way that actually respects or reflects the true uncertainty in the conditional probability distribution. So why is this useful for those of you who are potentially thinking about the commercial value of this? We think it's useful because it can help us with a range of tasks that I'm listing over here. Right? And it can change the way we weigh signals. It changes the way we actually identify and potentially properly escalate these ambiguous cases and bring it to human kind of expert attention. We can also refuse low confidence automation, which can actually hurt our bottom line, as that the trading strategy kind of showed us. So I think this could be actually relatively easily incorporated into the workflow of a lot of these AI-driven decision making, but in a way it makes it more kind of mindful of the where and when we can actually trust the LLM to give us right answers. Okay, so that's kind of the practical takeaway of the first paper. Now let me actually talk about the second paper here. The second paper is kind of a further opening up the black box. We want to get at a sense of the interpretability and even trying to control the behavior of the LLMs. So what is the idea behind this? As explained, right, the main question we're asking in this case is what is really the reasoning process of the LLM when it's making a financial judgment? Okay, so in that sense, we're really trying to open up the black box here. How do we actually possibly imagine that? Let me actually bring back this example I showed you at the beginning of the talk, which is, based on the information below, try to make an inflation forecast, right? So yes, the black box will give you a number, and based on what I just described to you in the first part of the talk, you now have a sense, maybe you can get a kind of a confidence interval behind these numbers as well. But there's still one big question that remains, which is, how on earth did LLM find out or decide that this is their forecast, right? What is the reasoning behind this? What are the key information they are considering to justify this decision, right? Especially when we are making high-stake decision in a high-stake decision-making setting, you really like to know what is the reasoning behind this. And even with the uncertainty quantification execution show just now, that still doesn't answer the question we just posed just now. So what can we do differently? Well, what we can do differently is that we would like to actually think about interpretation as a way to address some of the things that, things like, for example, backtest or kind of a prediction-based decision making simply cannot answer the question sufficiently. Right. Another thing is that how do you affect the behavior of the LLM? You might prompt it to be more cautious. You may want to prompt it to be more optimistic, but you will see, as we'll show you, none of these actual reliable ways to control the LLM behavior. Right. By prompting LLM to be more cautious doesn't necessarily make it more cautious, and by prompting to be more optimistic, it doesn't necessarily behave as a more reliably optimistic agent. So we need a more foundational understanding in order to control this kind of behavior in a more reliable manner. For that purpose, let me again try to show you a little about the technical background behind what the LLM does. This is really like opening up the black box and thinking about what the transformer is. Right? A transformer takes some raw text. This is the prompting information, and then it passes through layers of a neural network, performing what's called the nonlinear transformations of the embeddings, and then finally generate that conditional probability distribution I showed you just now. Right? So this is where the kind of the neural language models at final output would be. But what's kind of interesting is that you take any of these layers over here. Let's say, for example, take the middle layer, right, of the embedding. That actually, in principle, summarizes all the information LLM has summarized from the raw data. Right? In light with the training, pre-training that is done, as well as the new prompt information you're given them, including the question you're asking. And all of those packaged together is summarized in a very dense way into what's called these kind of transformer blocks. So what we would like to do is actually try to understand what is the meaning of this transformer block, right? I'm going to use this analogy. Think about you're doing a brain scan, actually a brain scan. What would we do? A neuroscientist would do a brain scan by basically showing a patient various kind of images, or maybe text or music. And then they would, when they do the scan, they would actually try to pay close attention to what parts of the brain are activated, right? Depending on the type of images or sound or other kind of stimulation you're given to the patient. So for example, in this picture, you can see maybe positive financial news would activate this part of the brain. I'm making this up here. Negative financial news may be activating a different part of the brain and so on and so forth. Right? Now imagine doing the same analogy for these transformer blocks that I showed you on the previous slide. Right? If you're feeding some positive news here, you will see certain parts of the neurons being activated, and if you show other parts of the other types of news, maybe other part of the neurons will be activated. You want to do this in a way that is semantically sparse, meaning that there's a clear separation of distinguished topics. And that can actually be done in our paper. Essentially, this is the workflow. We basically feed a lot of different prompts with LLMs, and then use what's called a sparse autoencoder. I don't want to get into too much technical detail here, but it's basically a way of decompose or unpack the dense transformer blocks, which summarize the information from the prompt, the text, decompose into many tens of thousands of distinct semantic topics. Right? And then we'll be able to see, right, which type of news as prompt would be more likely to be associated with activation, meaning turning certain neurons in the sparse layer to be non-zero. That's what it means to be activating a neuron. So if you can find a common pattern in terms of what type of news activates a certain neuron, then you can actually start thinking about labeling that particular neuron. For example, if you find out that articles that talk about risk management is associated with a particular type of particular neuron in the sparse layer, then that neuron is likely going to be responsible for talking about risk management, right? And here are some other examples: sentiment, risk, market situation, and so on. And then once you get this kind of a sparse decomposition, then we can actually start feeding new news or new prompts to the LLM. And by looking at what part of the sparse layer is activated, now we actually have a name for them. We can then understand what is the decision making based on. Okay, so let me just show you some concrete example for this, if it's too abstract. Yeah, actually, let's just go to a concrete example in the interest of time here. So here is a example where we're trying to ask our LLM to make a prediction for, based on the recent experience of the U.S. economy, what would happen to the 3-month T-bill rate, right? So remember, the LLM would have no problem giving you an answer. It's just that we don't quite know what the answer is based on. What is the reasoning behind it? Well, if you actually pass this through the LLM, the sparse autoencoder that we built, you would actually see what exactly are the topics that are being activated. Here's an example, right? If you're asking information questions about S&P, the market index, you see the type of topics being activated would be related to financial market instruments. These are, by the way, broad level topics. Underneath this, there are going to be much more specific ones, such as the equity market, IPO, foreign exchange, and so on. And if you change the topic to, say, asking LLM to predict real GDP, now you see that it's actually the macro finance, economics type of topics getting activated. One more example, if you're asking about the real non-residential investment, the topic that will be activated over here is going to be these blue kind of, I guess in this case, summarized as corporate finance topics. So you can see that these can actually shed a lot of light in terms of what are the key decision-making basis for the LLM. And just to wrap up this up, now I can imagine once we can identify this kind of sparse autoencoder, right, in terms of the semantic classification of the decision basis, you can imagine steering any one of these elements to try to change behavior. For example, if you find out that this, by the way, is steering the LLM in terms of the risk aversion. So suppose you find out that a particular neuron in the sparse autoencoder is responsible for risk aversion. So then you can actually steer it by actually numerically change the value to be more positive or more negative. And you can see in our experiment here, this kind of SAE-based steering actually does reliably change the LLM recommended stock allocation. For example, if you steer up the risk aversion, you will see that the LLM recommended stock allocation will go down from somewhere about 74% to 67%, dropping. Okay, let me contrast that to what would happen if you actually just prompt the LLM to behave more or less risk averse. You see that actually it doesn't behave the way we would like to be. Regardless of whether you prompt it to be more or less risk averse, the allocation mysteriously always drops, which is actually just another piece of evidence suggesting unreliability of controlling LLM behavior without opening up the black box. Okay. All right, so I'm already kind of running past the kind of originally budgeted time, but let me just very quickly maybe talk about one more thing, and then we'll leave some time for Q&A. The last thing I want to talk about is how we can actually incorporate some of the things I mentioned just now into what would I refer to as human AI collaboration. I think this is really where things get really exciting. Okay, let me actually talk about this primarily using two pictures to show you what we have in. Okay, so here is an example of a human AI collaboration in loan underwriting, right? I don't know if we have some audience coming from the banking industry here, and how you are incorporating agentic system into your decision making. In this case, loan underwriting or credit underwriting. Okay, so imagine that the system receives a loan application which has some kind of particular information of the applicant. What would be a human AI collaboration system doing? Well, first, you probably run it through a initial review by a agentic system, analyzing data, assessing risks. Remember that by performing this initial assessment, you would also be able to quantify the uncertainty behind the initial assessment. Right? You would be able to reliably classify this into low risk, quote unquote, standard cases, or uncertain, needing a judgment, or maybe high risk or high uncertainty cases, very complex, right? And depending on the initial classification, you would then be able to send the workflow to either a AI agent, which would then do the automated decision, kind of an underwriting decision without any human interference whatsoever. Or if it's in the kind of the medium uncertainty case, you would send it to a human loan officer, which has the necessary expertise, and then evaluate. And maybe for those really highly complex cases, you actually put a human AI team to analyze, maybe to gather more information, and then try to assess it, and then finally reach the answer. Now, of course, just as any AI system, you would make it a kind of a feedback loop. So with the final decision, you monitor the decision making and try to provide the kind of a next round of feedback to the initial review, as well as the agent and the human agent teams, to try to make this process iteratively improved over time. Right. So here is to us a very exciting case. Just the ability to be able to open up the black box allows us to assess what are the cases that actually could be safely dedicated fully to AI, which are the cases that would benefit from some kind of a human expertise, which are complementary, let me emphasize, but also expensive, right? Limited human resource, human expertise. So we want to use this in these high value cases there. Here's another example, perhaps even more ambitious, is imagining what would happen if you actually put a human AI team of agents, let's all call them agent here, into a corporate kind of boardroom, right? So in this case, I'm thinking about an investment committee. Suppose you're trying to assess a proposed investment, and deciding whether it's worthwhile for the firm to allocate capital to it or not. Well, you can imagine put together a team of both human experts. In this case, we have a committee chair, we have the CFO, we have the risk manager sitting on this side of the board, and then we have a bunch of agents. These agents are designed to play different roles. There are these bullish market analysts, they're bearish analysts. Their job, as the name suggests, are basically to do the best they can to make the bullish case and make the bearish case. There will be also the legal agents who are very acquainted with the kind of the legal implications and what you can do, what you cannot do. There will also be the financing agent, which presumably can be providing some complementary kind of financial analysis, above and beyond what this human CFOs would be able to do. And this could be really formulated as a multi-round debate, right? As these different agents and the human agents included make their cases for whether they are pro or against the investment decision. They would incorporate all the arguments that have been made in the previous rounds by both the human and the AI agents. And in the end, these kind of arguments can be pulled together, and the committee, and in particular the committee chair, would then be able to make a more informed, but more importantly, a more robust decision, because now you have really heard about, right, what are the kind of adversarial cases could be, right? You can actually think about all the potential easy to neglect kind of edge cases, and that's why you can make a more reliable decision at the end. So I think that kind of describes what we're heading to here, is that we want to use kind of tools we're building in the previous two papers for both uncertainty quantification and the kind of the sparse autoencoder based kind of the interpretability, what's called the mechanistic model interpretation, into ultimately building an effective human AI team. And I think for a lot of kind of a high-stake decision-making cases, which I think are abundant in financial settings, we could really make the best usage of AI as well as our human expertise by putting together the effective team together this way. Okay, so let me just summarize. I've kind of talked enough. So I think this is basically the three takeaways, if you want. One is that we can actually relatively easily assess the confidence in today's leading LLM models. If you're actually interested in how you can construct this kind of confidence measure, I recommend you to check our paper. There's actually a very easy way to incorporate that into a usual API with the interaction with the LLMs. For leading models like ChatGPT or Gemini, or of course all those open way models, you can easily get this distribution and incorporate into your workflow. The second point is about control, right? If you can understand the AI systems better, inspect them and diagnose them, and steer them, then you have effectively more control of their behavior. You know what their biases are, you can debias them. You know when to kind of steer the model behavior in a reliable way, so you don't have to do this in a kind of a black box kind of prompting way anymore. And then the third thing, which is kind of work in progress, as I mentioned, is that by putting these two kind of tools together, we can actually think about designing a more effective workflow that incorporates the complementary skill sets of both the AI agents and the human experts to hopefully build a more effective solution for high-stake decision-making settings. Yeah, so that's really what I want to share. I saw that there are some questions already in the chat, but I'll be happy to open it up to questions at this point. Thank you very much.
Thank you, Professor Chen, for your valuable insight. Just as you said, we already have several questions in the chat box. Would you like to answer those questions first, or?
Yeah, sure. I think that's only fair. So let me take a quick look at these questions over here. I guess there's a question from Brian, if I get that right. Inside autoencoder, different concepts should be activated when certain questions are asked. Is there a predefined map table? How are the weighting and index charts you show decide? Okay, very good. Yeah, so this is getting into the weeds of how we actually built the sparse autoencoder. We actually do have a predefined kind of a semantic class category. The way we do this is in a what's called a hierarchical structure. We'll start with these high-level categories, such as these are macro topics or firm-specific, maybe risk management, maybe financial, these kind of high-level topics. And then within each category, we have more refined topics. But as you can see, the way we design or handcraft these topics are with a heavy kind of a financial tilt. We want to kind of scan, if you want, the financial part of the brain, right? The LLM can do many things, but we are primarily interested in the financial part of the brain. And that's going to be related to the second part of the question, which is how the weights in the index charts are shown. It's effectively looking at based on the nature of different questions, the degree of activation of these different semantic topics at a sparse layer. If the activation is strong, that tells you that the weights on these topics can be high. Okay. I hope that answers your question, but if there's any further questions or clarification needed, just please feel free to unmute yourself or follow up with the chat.
Yeah, thank you.
Sure. So the second question, I think, is by David. For macroeconomic analysis, have you considered using prediction markets like Polymarket as an external validation signal for your forecast or conclusion? In addition, have you explored multi-model AI collaboration? Yeah, okay, so fascinating question here. it's very interesting that you can potentially try to use probability market or prediction market in general as a way to really, quote unquote, evaluate any forecast the LLM can generate, right? In our kind of a second example here, I assume you're talking about the second paper here. What we're interested in actually is not as much about whether these predictions are accurate anymore, right? Just like in the first paper, we have this news classification, and because these news are very kind of a short term in terms of the impact, we can very quickly check whether the actual market reaction is positive or negative. So that's why we have the ground truth very quickly. I understand in the spirit of your question here, you can potentially use a second benchmark, which is this kind of a prediction market, right? Kind of aggregated opinions from the participants in the police prediction market as another form of benchmark to compare the accuracy. But what we are primarily interested in is whether the forecast is accurate or not from the LLM. We want to know what it's based on. Right, so it could be a fantastic prediction, but I still want to understand what is the reasoning process behind it, right? Of course, if the prediction is terrible to begin with, maybe understanding why it is so is less valuable. But it could maybe imagine then understanding why it is wrong could help you kind of improve upon it. Right? So that's kind of a argument for why in either case you would like to understand better the reasoning behind it. Okay, so here's another question from Brian. Thanks for the participation, Brian. This question is about inside each concept. What are the underlying source data? I guess you're still referring to the how the in SAE these different concepts are determined.
Yes.
Yeah. Very good. So the way we actually train the sparse kind of sparse encoder and find the labeling of different concepts is by feeding in all these Reuters kind of financial news. We have various kind of financial news, so we can feed them in and then get at the activation of the sparse layers time and again. And then we try to find common patterns, right? So example, looking for, let's say, the top 5 news articles, top 50 news articles that are associated with the activation of the first neuron in the sparse layer. That tells you there must be something in common among the first 50 articles that causes this first neuron to be activated. So we then package them into another LLM actually, and to ask the LLM to generalize for us what is in common among these 50 articles. That's how we actually find out what is the topic that is associated with this first neuron. And we do that one by one for all the neurons in the sparse layer. Okay, next question is from Vida?
No,
right?
I think that's the question.
No. Okay, so that's
welcome everyone. Yeah.
Got it. Okay, sorry.
Yeah, I think we are. If anyone have any questions, Brian have another questions. While you are answering Brian's question, if anyone want to ask online, you can unmute yourself. Okay, Professor Sun, please. Brian's another question.
Sure. Yeah. Brian, I feel like we probably should set up a follow-up call given all the fantastic questions.
I'm very curious.
No, I really appreciate this question. These are fantastic. So, in human AI collaboration, how do we validate the work recommendation of each agent? This actually is very important. The way we are actually building this is work in progress, so I'm a little bit speculative here. The way we're currently thinking about doing this is actually have another agentic system trying to do the evaluation, because this, as you can imagine, in many of these situations, these recommendations are could be erring on the more qualitative side and may not have easily benchmarkable kind of ground truths you can do. So we would have to actually develop a somewhat based, if you want, subjective kind of evaluation system. But rather than having, our research do this by hand, of course, that would not be able to scale. We actually use agentic systems themselves to try to do the assessment. Yeah, but as you can see, that absolutely matters for the final result. If we cannot, right, do kind of reliable validation for these kind of intermediate outputs, then to think about how this agent would interact is going to be difficult. So, for example, in that agent debate, the one that I talk about here, how do you imagine kind of using human AI teams to make a significant kind of strategic decision at corporate level? A lot of this will depend on how these subsequent kind of debating points, if you want, made by either the AI agents or human agents will put weights on the previous arguments made by the previous rounds of debates. And those weights would absolutely have to take into account which arguments are more likely to be valid, should be putting more weight on, and so on and so forth. Yeah.
Thank you
so
very
here's
much.
another, I guess we have another question. Do we still have time to do this?
Yeah, we have time if you're okay.
Sure. Okay. I really appreciate all the questions here. So this is from Brian Chang. Have you compared the different leading LLMs on the market in terms of their performances? If so, do you find one outperforming the others? Would you run multiple LLMs in parallel and democratize their decision? Okay, yeah, this is a very good question. The short answer is different LLMs absolutely differ in their performance. It is often kind of a task specific. So depending on the nature of the tasks here, the different LLMs supposedly have different performances. I can give you one anecdotal evidence we have. When we run the trading strategy based on the news classification, right? Constructing this long-short strategy based on news, overnight news. What we found is that the GPT-4o actually had a quote-unquote quantum leap in trading strategy performance compared to earlier generations of GPT models. Right, that was where we saw that the trading strategy all of a sudden become actually significantly more profitable. I think that goes to show you that as these models improve, they really could become more and more reliable in overall. But still, what we showed you is that in our study, even for a relatively strong model, there's still room to kind of tell apart situations where the model is uncertain versus the model is certain, because it's not determined so much about the model's capability, right? If you're feeding garbage or noise to the LLM, no matter how strong they are, they will still not going to be able to give you reliable prediction, and that should be the case, right? So if anything, these will make this kind of a methodology based on inner confidence even more effective as the model's capabilities improves over time.
Thank you, Professor Chen. Due to time constraints, the speech concludes here.